All right. Hello, everyone. My name is Peter Rosendroff. I'm a professor of politics at New York University and also affiliated with the Princeton Sovereign Finance Lab. We have a session today on the politics and economics of sustainability. We have three papers before us. One on Ghana, one on Argentina, and then a paper on thinking about safe assets in emerging markets. We'll go in that sequence. We'll have all three papers presented, and then we'll open it up for Q&A after all the three papers are done. If you'd like to ask a question, signal to me. I'll run the show. We have some time, so I suggest 15 at most 20 minutes per paper, I guess, given that there's three of us for an hour and a half. Thank you all for being here. Let's kick this off with Kofi Gunu from the University of Oxford, who will be talking on Dithering Debtors, Credible Creditors, a structural power analysis of Ghana's 2014 IMF bailout request. There we go.
Can you hear me? Okay, that's all right. And I am waiting for the PowerPoint. Just test this. Perfect. All right. Good morning. My name is Kofi. I'm a PhD student at Oxford, and this is actually part of my PhD project. And as I start, I feel obliged to apologize that there are no elegant models in this presentation, no regression tables. It's a qualitative research project and an intensive deep dive into how one country, Ghana in this case, approached the decision to request an IMF program in 2014. So the motivation for this project, I start with the long tradition in IPA research that seeks to understand the specific conditions under which countries turn to the IMF for assistance. And without simplifying dramatically, I would argue that the existing research falls into two main buckets. There is a sort of economic story that says, a country facing balance of payments problems, very low reserves, would turn to the IMF. And you have, a response in the IPA literature that emphasizes the sort of political factors that might make some countries more predisposed to requesting programs. And that preference could be ideologically driven, it could be driven by interest group politics, but the focus is on governmental preference. I think the existing literature covers the bulk of requests episodes, but I argue that it may perhaps be given as little leverage when it comes to a specific group of cases in which programs emerge despite strong and observable resistance from governments. So I'm trying to understand how it is that governments that start out quite resistant to requesting IMF programs nonetheless come to do so. And I think this universe of cases includes the UK in 1976, Thailand and South Korea during the Asian financial crisis, Greece, Ireland, Cyprus, Portugal during the Eurozone crisis, Sri Lanka most recently in 2022, and the focus of this paper, Ghana in 2014, and I would argue again in 2022. So I do think a lot of the existing literature could plausibly explain these switches from IMF resistance to requests. So, we could tell a purely economic story where, despite, resistance, despite noises about never going to the IMF, the crisis becomes so severe that governments have no choice but to make a request. We could also tell a reform push story, drawing on the work of James Vreeland to argue that despite resistance, a government may come to see the IMF as a useful international ally in its fight against domestic veto players. And you could have an economic ideology story where there's a sort of an ideological change of heart, where a government perhaps moves from being left-leaning and presumably anti-IMF to more right-leaning. And of course, Jonas is in the room. Jonas might argue, and I have, in invoking Jonas, lost my slide. But Jonas might argue that you could have this switch as a result of lobbying and agitation efforts by domestic interest groups that may stand to gain from an IMF program. I think these are all plausible arguments. What I think is missing is an attempt to also study the role that external financiers might be playing in pushing governments from resistance to acceptance. And I think the existing literature has external financiers in the story. They are always present, but never at the center of analysis. And what I'm trying to do in this project is to foreground the role of external financiers. And I describe external financiers quite broadly to include your classic private creditors, bondholders, official creditors, and also in my case, donors as well. And in making my argument, I invoke a concept called the structural power of finance. And anyone who's read Jerome Rous's book, Why Not Default, will be familiar with this concept. And it's an old concept that's been resurgent in recent years. And it's basically the argument that financiers, because of their role as their position as controllers of capital in the international financial system, exercise influence over national policy. And keeping this in mind, drawing on this argument, I argue that in some instances where you see this shift from resistance to IMF requests, you have financiers exercising structural power, and they do this by presenting credible disinvestment threats to governments. And the paper does a number of things, but really the main takeaway I hope you can walk away with is first the argument that the structural power, and I'm working on this terminology, foreign structural power I'm calling it for now, can and has been wielded strategically to incentivize governments to request IMF programs. But beyond that, its success is not guaranteed. So the mere fact of wielding structural power does not imply that governments will be amenable to it, that the success or failure of the strategy depends on the credibility of disinvestment threats. And that credibility in turn depends on two questions: how dependent governments are in the first place on this external finance, and I'll focus mainly on this first point. But in addition, also how reliant external financiers are in turn on governments. And my argument is that financiers could be reliant for a whole range of benefits, financial benefits, geopolitical benefits, and it's really the interaction of these two factors that determines credibility of disinvestment threats. So on to the case study. So I think by my count there are about 7 papers this conference that mentioned Ghana, and for good reason. I think Ghana is really the sort of harbinger for a lot of the financial questions that we are dealing with in this conference, from debt restructuring to IMF programs. I specifically focus on Ghana's 2014 request because it really fits the profile of a country that quite obviously faced evident need for an IMF program. So in 2012, the country faced a succession of deteriorating economic conditions, twin deficits, rising inflation. At one point in June 2014, reserves were down to just 12 days of import cover. And yet we saw quite strong resistance to the idea of resorting to an IMF program. Even the IEO background on this program mentions the fact that the government was extremely resistant. And like Gregory Smith, who may be familiar to some in the room, I concur that a lot of this resistance was electorally driven. So the NDC government in 2014 was facing a really competitive election in 2016, and for a number of reasons, going to the IMF complicated the path to victory for the government. So there was a real interest in finding a non-IMF solution to the country's crises. And yet, in August 2014, we saw the emergence of a program, and I'm trying to understand what happened in the intervening period. I would argue that the existing literature does not quite explain this switch. So there were no weak veto players in Ghana. The president had a supermajority in parliament. There was no barrier to implementing austerity, which would be the argument in a reform push analysis. There was no discernible shift in ideology. In fact, top policymakers, including Finance Minister Tekpe, had very close links with the IMF. He in fact was, before becoming Finance Minister, an economist with the fund. So the existing literature would predict a preference for programs. And pro-IMF interest groups were simply not politically salient to have made a major difference. I think the economic story is very convincing. Of course, there was a precipitous decline in the country's financial position, but I argue that this does not tell us all of the story, and especially important when we look at the sort of reserves position, for instance. So reserves were quite low long before the decision to go to the fund. My empirical argument here is that in Ghana, structural power was at work, that both private and official creditors quite successfully were able to push the government toward the fund program by withdrawing and withholding financing. And to do this, I use process tracing, which is a method in qualitative research. And at the core of process tracing is the causal mechanism. So the causal mechanism is a series of sort of jointly sufficient steps that should link a cause to a hypothesized outcome. And the steps list both my expectations for the source of evidence I should be finding in the Ghana case to validate the story. So, first, we should see that policymakers declare a strong preference for a non-IMF response. And to do that, they are going to hopefully come up with a homegrown adjustment program. They would pursue alternative sources of financing to the IMF that are more costly than the IMF. In a second step, external financiers in response issue disinvestment threats. And disinvestment threats could take the form of withholding current financing or threatening to withhold future financing. And we should see these credit flows resuming right after the government requests or signs an IMF agreement. Policymakers then evaluate the credibility of these investment threats, determine whether or not they are consequential, both to the economic health of the country, but also to the regime's political survival. And then finally, we should see policymakers, we should see these sort of credible disinvestment threats weigh heavily on the choice to go to the fund. So I'm very quickly going to run through the steps. So my first evidence for the first step is that the Ghanaian government did indeed come up with what they call the homegrown economic stabilization program. And this was quite explicitly touted as a more palatable alternative to going to the IMF. it was a fiscal consolidation plan which would be a lot more would be gentler than what both creditors and the IMF were calling for at the time. Interviews with policymakers also revealed quite strong skepticism about the value add of an IMF program, and quite ironically, precisely because policymakers had past experience with the fund, they genuinely believed and were confident that they could manage the crisis on their own. And then you also saw a growing reliance on pricier sources of borrowing, including the capital markets, including both domestically and internationally, but also a lot of central bank funding. Financiers issuing disinvestment threats. So I think the first instance of this was that you actually had major donors in 2013 and 2014 suspending general budget support to Ghana. And this was very clearly a response to the economic situation, and was quite explicitly linked to the government going into an IMF program. So donors told Ghanaian policymakers we would not resume general budget support. And quite substantially, as I will show, quite substantial general budget support until the government signed an IMF program. It's no surprise as well, you had a lot of capital flight, and the government was excluded from the international capital markets. The third step, so I argued that policymakers then evaluated or re-evaluated their preferences based on these credibility threats. And the evidence I found, both from interviews but also from secondary literature, was that policymakers saw this threat to be extremely credible. One, because official flows just constituted a very significant portion of their revenues. For instance, general budget support constituted 14% of total tax revenues, and some 31% of public spending on non-financial assets. So the point is that, as a deputy minister expressed to me, not having this money placed the government in a very tough position. And same goes for private credit as well. The Ghanaian government was highly dependent on Eurobonds, syndicated loans, and domestic bond issues to fund its deficit. And so the upshot is that the cutting of these credit lines had quite consequential effects on both the government's political and economic position. And this is the last step. I argue that as the series of evidence also shows that the choice to make the switch to the fund was quite heavily influenced by these credible disinvestment threats, including, I think, in the World Bank and EU joint evaluation report, which hints at the role that this sort of suspension of general budget support had in prompting policymakers to turn to the fund. So, concluding, single case study of Ghana. What I hope is that it's highlighted what I consider an underappreciated role that external financiers play in prompting IMF requests, hopefully contributes to the larger literature on structural power, and prompts questions about broader implications on the design and legitimacy of IMF conditionality. In the future, I think it would be really impactful if we go beyond Ghana and look at other case studies, including the ones I listed before, but do cross-country comparisons with negative cases. So cases in which, despite where resistance is successful, where governments quite strongly express an aversion to the fund and are able to ride out their crises without going to the fund. And I think we could also benefit from research on the effects of program compliance and outcomes in these specific cases of sort of non-cooperative turns to the fund. Thank you.
Kofi, thanks very much. Continuing on the theme of returns to sustainability, we have Chris Marsh from Exante data on Argentina.
Thank you. Thank you. Yeah, sorry, I've lost my name badge. So my name is Chris Marsh. I'm going to talk about Argentina's dilemma and the sustainability challenge they face. And at the same time talk about debt sustainability in general, so give a sort of a critique of what I think are problems with the current framework. This was originally a paper with Brad, who sat there, Brad Setzer, but since we initially wrote the paper, I've kind of gone back and rethought some of this and written some new equations, and Brad can't be responsible for those in case of any mistakes, but hopefully there are none. So I think from the experience in this conference so far, there's a lot of innovation in relation to overcoming legal challenges when it comes to restructuring and the coordination challenges of restructuring, but there's very little criticism of the sustainability analysis framework itself, the formal framework that was introduced roughly in 2003 after the original Argentina crisis at the turn of the millennium. And yet I would argue that the framework itself represents a substantial analytical setback for the subject, and it explains many of the challenges that we've faced since, including in the Eurozone, but especially in the current Argentina case. So what have we lost with the DSA framework? I mean, in short, the DSA framework comes down to the fiscal analysis of the fiscal accounts, so the I minus G equation, and yet that fails to put the fiscal accounts in a broader framework within the economy as a whole. So I'm going to argue that in the process of institutionalizing the DSA, we've lost sector consistency checks. The analysis of the internal and external balance considerations from James Mead in the early post-war period, and then, of course, Tinbergen's policy assignment. We basically nowadays have, when it comes to an IMF program, it almost comes down to we have one policy variable, the fiscal balance or the primary balance, and we don't properly assign other instruments to other objectives, including the external accounts. And of course, we fail in this process to do any analysis of the balance of payments. I think all of this is because of the DSA shifting the focus to the fiscal policy above sector linkages. So let's give an example, or just a very toy example of how the sector accounts set out, which happens to be a kind of a useful summary of Argentina's challenge, right? So think about three sectors: the fiscal on the left, in the middle we have the central bank, and the private sector on the right of the three on the left there. Fiscal has debt in foreign currency, which I'm assuming is all external, just for simplicity. Central bank has foreign assets and local currency liabilities. This is money and near monetary liabilities, so not only base money, but these very near-term 1 week or even overnight deposits. And the private sector has claims on the central bank and claims on the rest of the world, foreign assets, that's F star. And if you consolidate these three, then you have the external accounts and the balance of payments. And then we have the flows in relation to these. We have the primary surplus P minus transfers to the central bank Z. And the private sector generates an external surplus from trade and goods and services, and then pays a primary surplus to the government. And then they have interest on these assets and liabilities. This is basically the simple framework that we use to do DSA by focusing on the left exclusively. So, gone the wrong way. So you can look at the linkages between different sectors here, right? For example, the fiscal debt is a balance of payments item. So this comes down to the transfer problem of the challenge of reparation for Germany in the interwar period that Keynes pointed out from 1919 onwards. So the fiscal accounts are necessarily linked to the external accounts when your debt is external. The primary balance is linked to the private sector. It's how much FX you can, or how much local currency you can generate from the private sector domestically. And this Z here is a transfer to the central bank to support them in their monetary operations. And of course, there's also the link of the exchange rate. The currency, the debt is in foreign currency, so the exchange rate, which is implicitly a BOP monetary phenomenon, is also a link to the actual fiscal account. So you can't really build fiscal sustainability analysis without looking at all the accounts together. So, but let's just look at the fiscal accounts as we normally do, right? So we do the change in the debt is decreasing in the primary balance, less any transfers to the central bank, and then you get the interest on that, and you divide by GDP, and you get that the change in debt is the sort of minus the primary balance plus the interest relative to growth in foreign currency, where G star is the growth in dollar terms. Or on the right, just in local currency terms, when G is in local currency terms, you have to allow for the exchange rate depreciation when doing your debt calculation. So a depreciation of the exchange rate, which is a positive E here, adds to debt to GDP because of the foreign currency denomination of your debt. And so that's a crucial feature in the fiscal accounts. And if you think about this in terms of thinking about sustainability in a forward-looking sense, that your primary surpluses, the net present value of your primary surpluses are determine how much debt you can hold today, which is how you should properly do the DSA. It's a forward-looking iterative process. You find that the debt sustainability, the current debt that you're holding, the sort of the horizontal line here, you need to be generating net present value of future primary surpluses to achieve your existing debt stock. Now, as the exchange rate depreciates along the bottom here, so 1 plus E being the depreciation rate, then the net present value of your primary surpluses, because you're generating local currency surpluses from residents, your net present value is a declining function of the exchange rate depreciation. And as you go below the dotted line here, you enter a Ponzi scheme. So essentially, if your exchange rate depreciates too much, given your existing primary balance, then your fiscal policy becomes a Ponzi scheme if your exchange rate can't be controlled. So that's the fiscal-only accounts. But let's just think, well, what about the central bank here? Now, this is the big challenge in Argentina. And you really need to look also at the central bank of BCRA, the Argentina Central Bank Sustainability Problem, in order to understand sustainability in Argentina. So you can do the same process, right? You basically iterate forward on the central bank's net liabilities, and that has to equal the net present value of its transfers from the government plus the monetary income on the foreign exchange reserves that they have, assuming here that the monetary, the initial base money or monetary liabilities is equal to the reserves. So you see that you have your net present value of Z, your transfers from the government, which in Argentina are zero at best and often negative, which is bad because they're basically having to print money to pay for the deficit. But also you have your I minus G, or interest on reserves less the interest you're paying on your liabilities. And your interest on reserves are increasing in the exchange rate because you're getting foreign exchange from the reserves. So if you can depreciate more, then you get more interest on reserves, and that allows you to pay for the interest on your monetary liabilities. So the relationship between the exchange rate depreciation and the net present value of the central bank's income is an increasing straight line, so that if you depreciate more, then the central bank is more sustainable. There's a no Ponzi relation above the line for the central bank here as you depreciate. Now, this gives you the main liability items on the Central Bank of Argentina. It has base money, of course, in blue. The chart on the left is in natural logs because not in nominal terms, it's just impossible to read. So you can see that the base money has increased sharply over the last sort of 5 or 8 years or so. But the BCRA securities, these near monetary liabilities of either overnight, 7 days, 14 days, or whatever, have grown even larger than the base money. On the right, you see the ratio of BCRA securities to these two liability items. It started off around 50% in 2019. By the end of last year, 3/4 of the liabilities of the Central Bank of Argentina were these BCRA securities. And the growth in year-on-year terms of total base money and BCRA securities has been between 60 and 180% over the last few years. So the central bank balance sheet has been expanding very rapidly. And a lot of that has gone into these securities, which are actually quite expensive for the central bank. So the policy rate on the left here is the official rate that they use to try and tighten monetary policy. And then the line below it is the weighted average interest on central bank liabilities, assuming that base money has zero interest. So it's slightly lower because there are base money liabilities. And you can see that the central bank has been paying between 20% annualized on their liabilities, and more recently as much as 100%, given the increase in these BCRA securities and the tightening of monetary policy. So on the liability side, they're paying, let's say 40 to 100%. On the asset side, you can use the balance of payments data it gives you the interest that they earn on reserve assets in the in the primary account of the current account. And dividing that by reserve assets, you can see that they used to earn pre-GFC between 5 and 6% on their gross reserves, and then more recently, they're earning like 0 to 1%, maybe more recently 2%, depending on whether you choose net or gross reserve assets to calculate this, because they have Chinese swaps, which probably not interest-bearing. So in any case, they're paying, say, 40 to 100% on liabilities. They're earning 1 or 2%. You put these things together on the left, you can see the huge mismatch. And because they have no interest-earning assets to offset this cost, the only way the central bank can pay the difference between the interest that they have to pay on their liabilities and the interest they get on their reserves is by printing more money. Hence, the expansion of the balance sheet, and hence the continued weakness of the nominal exchange rate, despite the fact that they're tightening monetary policy. So there's a paradox here that they raise interest rates to tighten policy, but the act of raising rates in Argentina, everything's turned on its head. It means your base money expansion is going to be even more rapid. And because you have no way of sterilizing that, you have no interest earning assets to pay for that, you end up with ever depreciating exchange rate because the private sector don't want to hold those assets. So just to put this in context, the left-hand side has the exchange rate projections from the IMF WEO in October 2018, and we see the exchange rate now from April 2024 through 2023 on the left and through 2028 on the right. So the exchange rate has never been under control in the program, and hence, and this is because the central bank balance sheet has never been under control, and hence they've never been able to control their debt to GDP because the currency continues to weaken. So, so visually you have this negative relation for the fiscal between the nominal depreciation. So more depreciation hits the fiscal because it's because of the FX liabilities, and more depreciation helps the central bank because they have FX assets. So if the central bank has to tighten monetary policy in this sort of hypothetical setup, that this shifts down the central bank sustainability line, and the only way the central bank can remain a non-Ponzi scheme is to have a steady state depreciation of the exchange rate, but doing so makes the fiscal authorities unsustainable, moves them into a Ponzi scheme, absent some other fiscal adjustment, some other policy adjustment. So the linkages between the central bank and the fiscal authorities are absolutely crucial. And of course, the way you can get around this is to consolidate the two. And if you just did the maths on that, you end up with a revised version of the sort of I minus G equation, where instead of just a fiscal-only expression for what the primary balance has to achieve, you also have a monetary adjustment which allows for the cost of monetary policy on the right. So this is a revised primary balance sustainability relation, and you can make some simple calculations as a function of the average interest on domestic debt, the average interest on monetary liabilities of the central bank, and given a function of the exchange rate. So the danger is that, say for example, you have a 7% interest on domestic debt and 10% depreciation. You think, oh, I need a 4.2% primary surplus to achieve sustainability in the fiscal. But you also need to add, if we just go down the column, 2.5% transfer to the central bank in order to make the central bank balance sheet sustainable. So the true fiscal balance should be about 7% and not, say, 4%. By the way, these columns, I've added them up just down the columns, but you could move between the two. So you could choose 7% on the average interest on debt and 36% on monetary, whatever. But the point is, the true fiscal sustainability, or the true primary balance for sustainability, is substantially higher than the one from fiscal-only analysis. Of course, how long have I got, by the way? Sorry. Okay, so one more thing we can do in order to complete the analysis is acknowledge that the private sector is also a player here. The private sector has a portfolio choice between domestic assets and foreign assets, and it earns currency from its net exports if its spending is less than its income, and it pays the primary balance. So the private sector essentially accumulates claims on the central bank and against foreigners, or at the bottom, the change in their claims on domestic assets and foreign assets as a percent of GDP is the savings investment balance of the private sector, SIP. So if they run a goods and service surplus and less the payments to the fiscal authorities, plus the interest they get on their previous assets, then they've got a surplus that they can allocate to either the domestic assets or foreign assets. So if we make a simple assumption that the change in money demand, or the change in claims on the central bank, the money demand, is just a fraction of the saving investment balance alpha. And we know the money supply from the central bank balance sheet equation, and we know the saving investment balance, so we can plug them in together, and you get like an expression for what the change in reserve assets of the central bank are in percent of GDP as a function of, well, the transfers from the government, the private sector saving investment balance, and then the interest on foreign assets by the central bank. So this is another expression for the balance of payments from a monetary perspective. And you can subtract that from the fiscal change in the government debt. You get an alternative expression for the primary balance, which is consistent with sustainability. And now sustainability is the change in government's external debt minus the change in reserve assets of the central bank. So a consolidated net debt position of the consolidated government. And now the primary balance is a function of the fiscal only expression, the I minus G, that Blanchard likes to emphasize, plus the cost of monetary policy, which is I minus the interest on reserves, the monetary interest minus interest on reserves, adjusted for the private sector saving investment balance and the portfolio choice of the private sector. So if the private sector is running a surplus on its, say, an external surplus, and it's willing to invest in domestic assets, then your sustainability relation is lower. In other words, they're buying domestic assets. They're helping you build foreign exchange reserves. So you actually got you can augment your fiscal balance, your sustainability related primary balance for the private sector saving investment balance. So we have this, which you can, by the way, do a little bit more manipulation on at the bottom here. I think the thing I would emphasize here is that when you look at it this way, then you really want to be thinking about the weighted average of the primary surplus of the fiscal authorities and the primary surplus, external surplus, the goods and service surplus, which generates the foreign exchange needed to finance your external debt and to build reserves. And that expression for your private sector accumulation of net foreign currency assets is the autonomous component of international transactions that Harry Johnson emphasized back in the 1950s, which is to say that when you think about the balance of payments, you think about these private actors acting within the policy regime and the economy. They can generate a certain amount of foreign exchange. And now that is, for Harry Johnson, the balance of payments. It's the private sector's ability to generate foreign exchange. And that is completely missing in the DSA framework, in that we don't allow for thinking about how they can generate foreign exchange to service the external debt, which is Keynes' transfer problem once more. So I'll very quickly finish up. By the way, this is the original Argentina program. The assumption was the primary fiscal balance would eventually move into surplus of a pretty low 1% of GDP. Slowly, this was from 2018 to 2022, but the external goods and service balance didn't move. So there was no analysis of how the private sector would generate the foreign exchange to pay for the external debt, the interest payments on the external debt. So we're missing all this in the debt sustainability analysis. No one seems to talk about it except for maybe Brad. So it's a major problem for thinking about sustainability. Very quickly, is Argentina sustainable? So we can just plug in some numbers to this equation to think about whether Milei is going to succeed, right? So I just threw in some numbers very quickly on the average interest on domestic debt, the growth in dollar terms of the economy. So I think you need to be achieving 3.8% of GDP primary surplus just for the fiscal only component. And then on the assumption we reach a steady state where the inflation comes down and the exchange rate depreciation is lower and your average interest on monetary liability is about 20%, you need about 1.1% of GDP in resources transferred to the central bank every year. So you add those two numbers together, you get 4.9. Now Milei says he's going to get 5% surplus, so that looks pretty close. The problem is twofold. First of all, we haven't allowed for the private sector saving investment balance here, so we don't know whether the private sector is going to be running a deficit, and so withdrawing foreign exchange from the economy, making it more difficult to service the debt. And in any case, in the steady state in Argentina now, they need to be achieving an accumulation of reserve assets plus a reduction in debt of roughly, I calculate, between 2026 and 2029-30, of between 8 and 9% of GDP per year. So so they have to accumulate reserves, they have to reduce their debt, and that's not accounted for here. So really, on top of that, the only way they can succeed in this is if there is a substantial inflow of capital of external financial inflow, possibly by residents. So very quickly, what is the private sector saving investment balance in Argentina? It's on the right here. In steady state, it seems to be about 2%, increased sharply in the pandemic as it did everywhere. We're back down to about 2% again. So the private sector doesn't save that much. It's not going to generate organically that much foreign exchange unless they change their capacity to export. But in any case, what we have in the private sector is a huge buildup in foreign exchange assets. On the right here, the net IAP of the private sector in Argentina went from about 50 billion in 2006 to above 200 billion today. So there is a world where the private sector could draw down these assets from abroad to transfer to the central bank, to rebuild reserves in line with the program. But in order for them to do that, they need to be sure that the real interest they're getting on the domestic assets, including from the central bank, is safe and decent and positive. And we've never seen the private sector in Argentina meaningfully draw down these foreign assets in the last 2 decades. So if that happens, then happy days. I think Milei can possibly succeed. But to do that, he needs to fix the central bank balance sheet. He needs to fix the gaping hole in the capital of the central bank and give them some interest-earning assets or give them transfers in perpetuity from the fiscal authorities. I haven't seen a plan that suggests they're going to do that. And there's no way to interpret the latest IMF document that that is the case. So is Argentina sustainable? Probably not. Thank you.
Thanks very much, Chris. Let's have Cristian Cuevas from Universidad de los Andes on safe assets in emerging economies.
Okay, thank you very much, especially for sticking around to the very last session. So yeah, I'm going to be talking about safe assets in emerging markets. Just wait for the... So, we know from US treasuries that investors derive non-pecuniary benefits from holding them. And they are willing to forgo a sizable yield because these assets offer full nominal repayment or can be easily sold. They are safe and liquid. And this gives sizable additional fiscal space for the US government. They are able to borrow at lower rates than the private sector. This has been shown to be meaningful for not only fiscal capacity analysis, but also for the strength of the dollar, also as a driver of capital flows. Think of global flight to safety during times of crisis, etc. And the question in this paper is if we can find the same pattern in emerging markets. So emerging markets, yeah, you can think of many different situations. Here I'm going to be looking at a small sample of higher income emerging markets that have, in the past 20 years, mostly borrowed externally in their domestic currency. They have improved their credit ratings, and they have been able to develop a deep local financial market for their debt. And I'm gonna check if these bonds have convenience yield, and I'm gonna characterize and make the differences with respect to advanced economies. So before going any forward, let me clear up a semantic issue. When I think here about safe assets in emerging markets, I'm not thinking about absolute safety. These government bonds for sure will have some risk, credit risk, currency risk, capital control risk, etc. The way I want you to think about safety here is on relative safety. If these assets are safer than the relevant alternative, okay? That's a difference with used treasuries. With used treasuries, we can think of like, okay, no risk at all, maybe. So I'm gonna derive these convenience yields for 9 emerging market economies from the perspective of a domestic investor and a global investor. The domestic investor compares all the assets in the domestic economy and measures returns in the domestic currency. The global investor has a portfolio of foreign assets and, importantly, measures her returns in dollars. And in the last part, I'm going to put these convenience yields on the left-hand side of a regression. I'm going to estimate their determinants, and I'm going to show you what's the difference between emerging markets and advanced economies. So think of a domestic investor holding a local currency sovereign bond. And in the paper, there is a full formal derivation. Let me give you just the relevant equation here. You have YT, which is the total yield of the local currency government bond. You can decompose that into a risk-free rate in the domestic currency minus lambda. That lambda is the convenience yield. Notice that the convenience yield lowers the yield on the government bond. So this is an investor that, because he gets non-pecuniary benefits from holding this bond, is willing to accept a lower yield. LT there is the default risk, and that last term is the covariance between default risk and the convenience yield. So if when credit risk raises, the convenience yield usually goes down. That term is negative, and that probably is going to increase in the total yield on the government bond. If you take the spread of this government bond with respect to a local private asset, for example, an interbank loan or a term deposit of the same maturity, you get that on the left-hand side, you have the spread between the two. YP is the yield on this 1 year, for example, term deposit. And that spread on the right-hand side can be decomposed into a differential convenience yield, a differential default risk, and differential covariance. So later, I will show that this spread, YP minus YT, is going to be driven by the safety or liquidity premia, the convenience yield, and not the other terms related to the credit risk. And in the data, for the 1 year maturity, for Colombia, Chile, Indonesia, Mexico, South Africa, and Turkey, I get that the average convenience yield, the average YP minus YT, it's about 60 basis points. So to give you a graphical example, take Chile. In this graph, the red line is a 1 year term deposit in a private bank. The blue line is the 1 year government bond in the domestic currency. You clearly see that the yield on the government bond is persistently below the term deposit. That means that the Chilean government can finance itself way cheaper than a bank. Now, you might look at this spread and say, well, there are many other things that can be going on, for sure. Financial repression, or maybe just banks are riskier. So that spread is fully explained by just like risk aversion. Well, I'm going to show you in a few slides that risk aversion, financial repression cannot fully explain this spread, and this is mostly due to this non-pecuniary benefit, this extra premium investors are willing to pay for holding this bond, for its safety and liquidity. Now, what about foreign investors? Foreign investors are more complicated because their benchmark asset or their alternative asset is going to be a dollar asset. So take, for example, a non-treasury safe dollar bond, for example, a AAA corporate bond in the US, an agency bond in the US. You can show that the yield, Y US, can be decomposed into the dollar safe rate minus lambda US, which is going to be the convenience yield on this dollar bond, plus L, its credit risk, and the same covariance. Now, this global investor, the alternative asset, is going to be a local currency government bond from an emerging market with its cash flows swapped into dollars via a forward contract. So I get the pesos from the government and I swap them to dollars. So both assets are going to be in dollars. Now, of course, this emerging market bond has not only credit risk, but these bonds are issued under domestic law. They might have regulatory risks. And for example, the emerging market government can impose currency restrictions, capital controls, taxation, etc. So I'm going to account for that. And I'm also going to account for the currency depreciation in default events and events of controls imposition. And the yield on this swapped currency, swapped emerging market bond can be also decomposed. On the left-hand side, we have the yield on this bond, the local currency yield minus the forward premium. And on the right-hand side, you have the decomposition is the same risk-free rate, dollar risk-free rate minus the convenience yield plus a subletter. Just focus, don't worry about the all those letters. Just that last term is mostly credit risk and regulatory risk, as I just described. So in the data, on the left-hand side, I have data for US bonds and these swapped emerging market bonds. I have data on default risk, and I'm gonna approximate the regulatory risk by taking the spread between a bond issued in foreign jurisdiction and minus a bond issued under the domestic jurisdiction, and that spread should account for the regulatory risk. And some other things, I'm not gonna give you all the details. If you are really curious or you cannot sleep tonight, you can go to the you can go to the actual paper. And then the differential convenience yield is gonna be the residual. So I'm gonna take the left-hand side, that spread, I'm gonna clean it up for like regulatory risk, default risk, liquidity risk, and I'm gonna get a spread that is gonna be the term in blue, the differential convenience yield. So what is YUS? Is the US agency bond, a AAA corporate bond, or a BBB corporate bond, all from US companies. And here I have data for a few more countries, Brazil, Colombia, Chile, Indonesia, Mexico, Peru. So you can see that these are higher income emerging markets, and you don't see cases of default, recent cases of default or crisis in these countries. And for I have data for the 5-year maturity, and you see there an average of around 30 basis points for the convenience yield, which is lower than the convenience yield of US treasuries. So far, I have shown you that these are residuals. I took these spreads, I got a residual, I called it a convenience yield, but I haven't shown you that they respond to the demand for safety and liquidity. So here I'm going to show you a simple regression. Again, in the paper, this is more formally derived, but I'm going to have this convenience yield on the left-hand side, and on the right-hand side, I'm going to regress against a proxy for the supply of safe assets, the supply of government bonds. We should expect beta 1 to be negative, resembling, of course, there is endogeneity, but I'm going to lag the independent variable. Beta 1 should be negative, resembling a downward sloping demand curve. I'm going to regress against the level of the monetary policy rate, YMP, to see how substitutable are with money, which is the most liquid asset. And then I'm going to regress with a few controls that control for risk aversion. So if this spread is purely risk aversion and there is no convenience yield, then beta 3 should be significant and beta 1 and beta 2 should be like 0. If there is a convenience yield, then beta 1 and beta 2 are going to be significantly different from 0. And I have here a few regressions of the global investor convenience yield and the domestic convenience yield, and you see that they are positively related to the local monetary policy rate. So when the central bank raises rates and drains liquidity, the liquidity value of these bonds increases. There is a negative and significant effect of the supply of government bonds, which captures this downward sloping demand curve for these bonds. And then I have a few controls for risk aversion or risk premia, which is the slope, those slope variables, the slope of the yield curve in dollars or in pesos, and you can see that they don't play a significant role. The output gap, the result is also robust to including the output gap to control for the state of the economy. And then I analyze the response of these convenience yields against the global financial cycle, and here is where the main difference with respect to US Treasuries shows up. So here we see that when the VIX index increases, so you have an episode of high global uncertainty, the convenience yield of the global investor goes down significantly. And that's not the case with the domestic investors. And regarding the dollar convenience yield, the global investor convenience yield, that's the main difference with respect to US Treasuries. In advanced economies and in the US, those coefficients are significantly positive. So when there is higher global uncertainty, the convenience yield of the US Treasury goes up significantly. And in the case of emerging markets, that's not the case. So the question is why? Maybe this is just a mechanical thing. So there is an episode of high global uncertainty, maybe the credit risk goes up, and mechanically investors are gonna be willing to pay a lower premium. But that's not what I find. So in the last part of the presentation, I'm going to show you the analysis of two exogenous shocks to emerging markets. One is the taper tantrum, which was triggered by the Ben Bernanke's speech in 2013 that signaled the end of large-scale asset purchases, and it was seen as a future reduction in dollar liquidity in the global economy. And many emerging markets responded by hiking interest rates. And the other exogenous shock is COVID-19, which is more like a global flight to safety. There was a global sell-off of assets, and investors had a preference for the safety and liquidity of US Treasuries. So regarding the taper tantrum, you see in the first column that it significantly increased the convenience yield of emerging market bonds. So this is the dollar convenience yield. So this is the global investor convenience yield. So as liquidity was going to drain, and it was going to be reduced, the liquidity value of these emerging market bonds increased. And in the second column, you see that this is mostly driven by the hiking interest rates of local central banks. So there was a drain in liquidity, less private liquidity, and this drove up the liquidity premium on these bonds. With COVID-19, the story is very different. You see in column 3 the convenience yield of these bonds significantly decreased. And in column 4, you see that what is driving, I have marked it in red, it's like a increase in the demand for US treasuries. So that variable there is the relative supply of US debt to GDP to local currency debt to GDP. And that coefficient during COVID-19 became significantly more negative, resembling that the demand for US treasuries became much more steeper. So just to conclude, so I have tried to show you an empirical result, which is that local currency emerging market sovereign bonds carry a convenience yield. This market is not entirely driven by yield-oriented investors. The main difference with advanced economies is that the global investors, they do not have their convenience yield depends on the nature of the shock. In bad times, their valuation is reduced. And I think, thinking of like future work implications of this result, if you believe this empirical result, there are open questions and future work remaining in emerging markets, because this is going to have relevance for the investor base in these sovereign debt markets. This loss of safe asset status is going to have implications for the volatility in interest rates, implications for fiscal capacity analysis, and lastly, on the effectiveness of unconventional monetary policies in emerging markets. Emerging markets did QE during March and June 2020. Local central banks purchased local currency sovereign bonds. Now, it might be relevant to know which of those investors, who you buy from. It's important because their elasticity is different. Thank you.
Thanks very much. Before I open it up, I'm just going to offer some quick questions to the speakers, and then we'll have questions from all of you. I thought these were all tremendously interesting papers. To start with Kofi on Ghana, I just want to say that it's so terribly important that we think about the demand side for IMF programs, IMF requests. Often most of what we do is focus on the conditions under which a country gets one, or perhaps what the specific nature of that agreement is going to be. And so explaining what sometimes we call delays in stabilization are incredibly important. There are some stories drawn from sort of the international political economy literature, right, about explaining delays to stabilization that are sort of fundamentally political in nature. Most importantly, the question is, who bears the burden of adjustment, right? Now, I don't know a lot about the Ghanaian case, but I suspect that there are important distributional consequences of this kind of reform. And we know from some work of many economists and others, using models like the war of attrition, that where there's uncertainty about who bears the burden, we get delay. And so it may well be that that's part of the story that's going in here. I'd love to hear your response. You talk also a little bit about pressure from external finance as driving the process. You know, to some degree, is it pressure, or maybe it's just prudence in the sense that, in order to invite the IMF in to offer some kind of adjustment, there's going to be just simple reluctance on the part of international lenders to do so until that invitation has in some sense been extended, right? Reluctance because who wants to send in good money after bad, right? And so it's not really that they're pressuring the Ghanaians to do it. It's more like, look, if we're not doing it, it's a prudent, responsible approach. Very quickly on the paper by Chris and Brad on Argentina, I again know very little about this. I'm astonished to see the story essentially about how the balance sheets of the central banks are often excluded from the analysis here. I found that particularly interesting. I just have a question that maybe hinges on my a lack of knowledge about fiscal accounting, which is how do we take account of who the holders of the debt are, whether it's domestic or foreign holders of those central bank liabilities in particular. And if it's just in some sense a net transfer domestically, can we expect the pressure on the exchange rate to be as severe as perhaps that you might be suggesting? But again, you'll explain more of that to me. And lastly, on Cristian, on the convenience yield, again, nothing I know very much about. I'm aware, of course, of what sometimes is called the home bias when it comes to investing, whether it's in the stock market or in other assets denominated in domestic currency. I was wondering if in some sense this is similar kind of idea to this notion that there's perhaps a non-rational or a cognitive error that happens with investors sometimes, which is to emphasize domestically denominated assets. But what is particularly interesting here with what you're doing is you're trying to put a measure on that to see how that varies across different shocks. And for that I found particularly interesting, but I'd like to hear more on that. All right, those are my very brief comments. Our first one, where should we start? We'll start there. Nicholas, yes? Yes. Yes, you guys should come and sit up here, absolutely.
All right. So my question is to Kofi. Kofi, very good to see this coming together. I know you've been thinking about this for a while now. And I think you shouldn't be apologetic for using a case study with no equations, because case studies have a lot of value. Having said that, I wanted to ask you a little bit about the implications of your findings, right? Because if I understand correctly, you have this idea of the structural power of finance, and all these financiers, they want the IMF to come in as a sort of kind of signaling device to ensure that the reforms are credible. Because the homegrown economic reforms are not seen as credible by external actors as a reform with the seal of the IMF. And I wanted to understand, if in a way, if it's like a market failure, like in macroeconomic models of signaling, if there's a market failure, then in a way the IMF is helping the country to signal its seriousness. And so I was wondering if that is correct to say then in a way the IMF is playing a positive role there, or is this a suboptimal outcome for some reason because countries are unwillingly bringing in the IMF. I wanted to explore here a little bit more about the implications of the situation for the country's welfare.
Should we take a couple of questions first and then give everybody a chance to respond? Mark, why don't you go next?
Thanks, and thanks to the presenters for the interesting presentations. So first to Kofi, and I suppose I should disclose that I had a material role in a number of the cases you mentioned, including Ghana. But, I think it's useful to think about a country, when you think about influence, it's useful to think about country cases and resistance, country cases that are repeat IMF users, and country cases that are very rare IMF users. And you get some revealing insights by thinking about it this way. Repeat users, it doesn't take a lot to push them into an IMF program. And I'm not entirely sure that cases like Ghana, that the deciding factor is really the creditors. I know the Ghana 2014 case, they were going to end up in a program. And they don't necessarily resist a program in the end. Creditor influence may have some impact at the margin on when they enter a program, but they're going to enter it. There's another class of cases that are rarer and more occasional users. I think of Turkey, where the regime has made it and you had that potential other case study, and you're right to want to look at that, where the regime has said, we're not going to use the IMF. And they've basically, since 2007, tried to avoid the IMF. Or the Eurozone cases, which were cases that nobody ever thought would be in an IMF program. So there was a huge gap to bridge in domestic political terms. And there were also huge creditor levers that could be pulled. And then there are other interesting case studies because of what private creditors are putting into their bonds. El Salvador 6 weeks ago had a condition in its bond that said, in the global bond they issued, that said, if you don't have an IMF program, you're going to pay more. So that's something you should think about as well. Now, the IMF doesn't like this. We can't stop it. But for your purposes, it's actually relevant to think about those cases as well. And when you think about it that way, you may have a richer story to think through. Both, what's the cost to the government? If you're a repeat user, it's less. What's the stigma, etc. On the Argentine paper, Chris, just so a couple of things. I want to say, people often say our DSA has no external component. That's not true. In fact, it's tied down quite a bit by external factors, both through the fan chart, which relies on the structure of the economy, including external factors, and through the gross financing needs tool, which is drawing on a shock to external finance, right? Moreover, if you're a gray zone case, like Argentina is, you have to pass a set of additional tests, one of which is, can solvency be restored easily? The other of which is, will the FX liquidity be available in a shock scenario to cover payments on debt? So, in fact, we're testing these things. Now, I'm not at liberty to disclose those two tests because they're considered market sensitive. But we do test pretty carefully the resilience of the DSA to external factors, just not in the way not in the sort of financial programming way you've written down, in a different stochastic way. But it is there. And similarly, the central bank balance sheet is there through the macro framework and our projections of fiscal accounts. So they are there, just in a different way than you've written in your equations. Anyway, I wanted to make that remark.
We've had two questions for Kofi and one for Chris. Why don't you guys respond for a moment, and then we'll go back for more questions and answers.
Thanks for the questions. All really great questions. On the point about delays to stabilization and sort of war attrition models, I absolutely agree that is part of the story. And I think these sorts of domestic obstacles to resolving economic crises contribute to preferences to request or not to request IMF programs. I think I'm perhaps far more interested in a different question, which is when, despite the existence of these obstacles, do some countries end up requesting while others are successful in resisting programs? And I think that comparison also goes to Nicholas's question, right? I make no moral judgment, sort of blanket moral judgment about IMF programs. I think you need to take them on a country-by-country basis, and there are certainly cases where that signaling device is needed, and resistance is just sort of obstinacy on the part of governments. But once again, it's the comparison between the positive and the negative cases. So, what I've discovered in some cases is that despite quite similar crises, private creditors and official creditors are not demanding the same sort of signal, right? So, for instance, I look at Nigeria at about 2014 to 2016, and you could make a very plausible case for resorting to an IMF program, and yet you did not have the same, I would argue, the same degree of pressure on Nigeria, and that outcome I would argue, has a lot to do with Nigeria's the balance of structural power between Nigeria and its creditors, and that is the sort of comparison I'm very interested in. I will certainly take a look at El Salvador. I think this is precisely the sorts of requirements and sort of creditor demands that I'm interested in and in teasing out. On the question of repeat IMF users and rare users, I have a rather interesting take on this, because I think that the history is often actually endogenized by the creditors. So a country like Ghana, precisely because it has had previous IMF encounters, is seen by creditors as a country that will go to the IMF. And very often, in the interviews I've had, I've been struck by just how confident creditors were that Ghana would end up in a fund program, despite statements from the government, despite protestations to the contrary. And I think that also informed the behavior of creditors toward Ghana. They were more willing to withhold resources because they precisely expected Ghana to do so. Not in Nigeria, right? Because Nigeria is a rare creditor. So creditors' response to Nigeria is, well, Buhari has said he's not going to the IMF. We believe him. We take that at face value because Nigeria has not been in an IMF program. And I think that's an interesting way to just think about how that history is endogenized by creditors. I would love to. Thank you.
Chris.
Thanks. So I think you asked the question about the residence of the holders of claims on the central bank, whether that matters. So Argentina had an interesting experience under the Macri administration, I think it was, when a lot of foreigners were actually buying claims on the central bank, and the central bank was accumulating reserves on the one hand, but liabilities to private investors on the other. And that experience was pretty bad because there was the non-residents eventually ran, and that caused currency pressure, and they had to run down reserves quite a lot to manage that process. So that was one of the problems, but that was eliminated from memory around 2018. Since then, I think it's entirely a domestic problem, and since then, of course, the inflation problems got worse and the currency depreciations got worse. So I think it has been mainly a domestic challenge, and the problem is pretty simple, right? If residents think that the real value of their claims on the central bank are going to fall because there's going to be value, then they run on the currency and try and get the FX, and then the currency does move, and then you end up with the inflation that they were fearing in the first place. So that's that one. Then Mark, on your comments about the DSA, I think your comments kind of reveal the main weakness with the DSA, in fact, because you're relegating the external challenges to the risks, and it should be in the baseline, right? So the baseline IMF program should fully account for the balance of payments relations, the flows. You said it's just in the fan chart. It's just you're applying risks to. Okay, I can put it another way, right? If you go to an IMF document at random, there's 90% chance that it doesn't add up. All right, so your baseline doesn't add up. Your external relations, the flow relations between the different sector accounts don't add up. So, you can claim to have a baseline which is based on a balance of payments analysis, et cetera, but the reality is you don't do it. So, well, yes, but this is one of the problems, right? I mean, when the DSA arrived, the emphasis became on the DSA and not the underlying macro relations that underpin the DSA. So the financial programming got completely sidelined and relegated. And as a result, nearly every document, I mean, the Greece program, the Argentina program, they're just nonsense. Well, I think you don't know what you're talking about, so we'll call it quits. But there's also there's also the challenge. Admittedly, the new DSA apparently allows for the central bank balance sheet, etc. The spreadsheet's impossible to navigate, right? So I imagine there's only a few people in the world who understand the DSA spreadsheet itself. But you should be able to, from the document, understand what the strategy is for recapping the central bank, organizing its financial affairs in a way which will be sustainable. And the last staff report, it wasn't clear, right? It doesn't explain that. You can't back it out from the tables.
Very good, thanks. Any other questions? We have some time. We started a little late. Jonas.
Thank you very much. Just a quick question to Kofi. Like you have this situation in 2012 in Ghana where there are policymakers that have links to the IMF that are don't have any difficulties touching the IMF. You have prior experience, as was mentioned just a moment ago. I'm really interested in your explanation as to like why, at least in public, these policymakers were making such strong statements against the use of the IMF. You argue primarily that it's about electoral kind of incentives in electoral competitions. I have to push you on this a little bit, at least. Like this was in 2012. The next election was not until 2016, so 4 years later. How would people in 2012, 2013 know the degree of electoral competition and whether or not the IMF was going to be a relevant campaign issue 3 years down the line, 4 years down the line? I'd like to know more about how you think about that kind of stuff.
Thanks, Jonas. Yes, I did sort of emphasize the sort of potential electoral costs, which I would argue were quite well founded because the government did lose quite badly in 2016. But they were not the only incentives at work. So first, I would, but do account for a lot of it. So any familiarity with the Ghanaian electoral system, it's a very hyper competitive presidential elections. And so, yes, actually, indeed, 3 years campaigns, it's a sort of continuous campaign, and even 3 years before the next election, politicians were gearing up for the contest, and they were also facing an opposition that was well poised to leverage an IMF program as a sort of a badge of failure for the government. And so I think these fears were quite top of mind for policymakers. But I think there were other factors that were just as or nearly as important. I think there was an attempt at signaling to markets that the government was committed to the fiscal consolidation program it had produced. And so the government was returning or planning to return to the capital markets. It was issuing bonds to residents and non-residents on the domestic market, and it had a story about fiscal consolidation. And I would argue that a lot of the statements, especially in the international financial press, was directed at that audience to assure them that the government knew what it was doing and that it was committed to staying the course. And then I think, lastly, I think just plain hubris can explain a lot of decisions during this period. I think policymakers were genuinely very confident about their abilities, and they would tell you quite proudly, I was at the IMF for so many years. They don't have anything more to contribute that I don't already know, that has not already been factored. And I think and they genuinely to the IMF staff in the room, I think they genuinely saw the IMF staffers who were coming in, most of them very young men in their 20s, sort of lecturing to them as just unfamiliar with the conditions on the ground. So I think there are a lot of factors beyond simply the electoral dynamics, but I think the election was certainly quite important for policymakers.
Yes, go ahead.
Thank you. Three brilliant presentations. I have a question for Kofi. Kofi, the various options that you have mentioned, and one being the the external financial institutions influencing the decision to go to the IMF. How do you separate, because there are all of these contribute to the decision, or some of them in combination. So it is very difficult to really, there is an attribution problem. So this is one. How do you, differentiate that without, it's a qualitative analysis you mentioned, but I don't know, because this question will be asked when you defend. The other point is that, for example, I come from Bangladesh, and Bangladesh went for an IMF program last year, $4.7 billion for over 36 months. Our economy was doing very good, but then Russia-Ukraine war, our foreign exchange reserves came down from $48 billion to $20 billion. Our exchange rate depreciated by 35% in 2 years. So the government wanted to take some reform programs. Now, those reforms would have are painful. So it went to the IMF, and then it can explain to the public that, you see, this comes with the program conditionalities, and we will have to accept it. So is that also an explanation that sometimes governments resort to IMF in order to shift the blame as it were, of taking painful decisions, reform decisions within the economy, which they can say that it's part of the IMF program, we have to do it. Thank you.
Thanks. Thanks for the questions and observations. I'll take the second first. And I mean, I completely agree that, and this is actually well developed in the literature. Governments that may use the IMF for its sort of scapegoating benefits for reform, to have a sort of scapegoat for reforms that they might already be intent on implementing. And I think that accounts for a number of these programs. Bangladesh, in this case, will not be part of my universe of cases. So, to the extent that one can parse out this intention to bring in the fund to endorse pre-existing reform interests, Bangladesh will not be part of my cases. I'm quite strictly focused on the class of cases where it can be shown that the government genuinely did not want reform, and I think that's one thing that's very interesting about the Ghanaian case. The homegrown stabilization plan was not much different from probably less steep in the time frames than the subsequent IMF program, but the government wanted the same sort of things: increasing taxes and raising revenue, but just wanted to do it on its own and on its own timeline. So, but my focus is on the class of cases where it can be shown that the government does not want IMF involvement. Yes, I would really appreciate your suggestions on how I can parse out the effects from different creditors. I think in the current case, I think Ghana is interesting as a case of a country that is quite heavily dependent on both. And I think you could find cases that have a sort of outweighed in, heavily in one direction or the other. That could be a way qualitatively to just introduce different cases. And I think in the current case, use a sort of reliance on sort of temporal variation. So the sort of suspension of budget support happens in 2013 and 2014. I would argue that as a strategy, that was quite detrimental to the economy because it pushed the government then to rely more heavily on pricier, private credit. So I think there was a sort of cause and effect working there. But I would hope to have a chat later on. Thank you.
We're coming towards the end of our allotted time. Cristian, do you have anything you'd like to add or say before we close?
Sure. Let me clarify the difference with the home bias that you raised. So the way I think about home bias that has been found like in the trade literature or international finance, to me it sounds, as you say, like as an irrational or something we cannot explain, by which an investor or a consumer has a preference for its own assets or goods. So I think what I'm trying to show here is something far more rational. You are an investor that wants an asset that offers full nominal repayment, or an asset that you can sold easily. So I'm trying to get at something very concrete. It can be confused, yes, with home bias, but I think I'm providing a more structural or more like formal view on this issue.
Very good, thanks. Any last of questions in the minute or two we have remaining? All right, with that, I'd like to thank the panel so much. Tremendous, very interesting. Thank you all. And I believe we adjourn for lunch. Is that correct? Yes, indeed. Across the road for lunch. Yes, indeed. All right, thank you all.